Hi, everyone. I'm Vaibhav, a member of the risk advisory team at Alex Partners. Following the UK Supreme Court's much awaited judgment on motor finance commission arrangements on Friday, I'm joined today by two partners from the firm, James Worsnip from the financial services practice and Tom Beard from the automotive practice. Today, we are going to unpack the ruling and the likely implications for lenders and the automotive industry going forward. So, James, if I could jump to you first, what has been your immediate reaction to the Supreme Court's decision from a regulatory perspective?
Well, thanks, Vaibhav. And I think there is a massive sigh of relief across the sector. What was feared could have been the result here is not going to be what transpires. The whole idea that there would be some sort of um, tort of bribery captured and a fiduciary duty threatened to disrupt not only the size of the redress scheme on motor finance, but actually have implications more broadly. So a lot more nuanced as a judgment. Two of the decisions went, if you like, in the lender's favour. One of the judgments upheld the Court of Appeal in relation to an individual called Mr. Johnson. And that's a very different type of claim. That's an unfair commission claim brought under the Consumer Credit Act. So quite different, a lot more favourable to the banks, and I think probably actually where the FCA always hoped to end up. So the ball goes back into the FCA's court now. It has legal clarity about the type of scheme that it's going to be organising. There will be certainly a legal cover, I think, for the undisclosed DCA arrangements and why they were deemed to be unfair under Consumer Credit Act. So they would have succeeded in a court process and therefore should be covered by a redress scheme. The FCA has always said that actually it didn't care too much about things, so long as they didn't uphold the regulatory principles that were important to them, then they'd be covered. So they'd always said that undisclosed discretionary commission arrangements were problematic and therefore likely to fall into a scheme. They now have essentially what they wanted, and they've probably got a bit more flexibility actually in terms of some of the parameters that they've been asked to consider.
Thank you, James. And then likewise, Tom, what does this mean for the automotive sector and car dealerships, particularly regarding commission transparency?
Sure. I mean, I'd echo what James has said, that there is a broad sigh of relief across the automotive sector as a whole, but it's not an entire free pass. Um, I mean, the direct impact of it is going to mean that dealers and lenders are going to have to renegotiate their products. Dealers are clearly going to have to work on, ensuring they comply with open book disclosure, um, and that could have a knock-on effect to certainly the smaller dealers. When you consider 85% of the dealer market are smaller businesses, family-run businesses, single shop type operations, getting the right level of compliance and making sure they're fully compliant with the regulations is going to be a huge administrative burden for them. I think broader than that, there's a likelihood that the overall cost of finance could increase, not to the extent that was maybe originally feared, but there could be an increase, and that will obviously have an impact in terms of consumers' ability to purchase new cars. They may defer the purchase of a new car. They may look to the second-hand car market as an alternative, and as a result, dealers will not only be reducing the overall income they make per deal, but they'll potentially be reducing the volume of deals they make. OEMs likewise will be looking at that too. I think because of that impact to dealers' income, they will most likely go back to the car manufacturers, to OEMs, and ask them, can we have a look at the deals and the commissions that we have on the product itself, on what we call the metal, to supplement the lost income. So there's a broad impact across the whole of the sector, and then obviously to lenders too, both the direct lenders and the captive finance companies within the OEMs.
And James, if I could come back to you, we know that lenders won't need to address historic commission arrangements to the extent that they had initially anticipated, but they will have to address those commission arrangements that are considered unfair under the Consumer Credit Act. What, in your opinion, are the resulting short and medium term implications for lenders now?
I think there's a lack of clarity at the moment about quite how far back in time lenders might have to go to look at historic arrangements that might be deemed unfair. We know for DCAs they've gone back to 2007, so they're covering a period between 2007 and 2021, and they're obviously expressing some concern that the data fields that they might have from that period of time could be weaker, inconsistent, and need a lot of bridging. If they were to try and do the same thing or across all of their arrangements, across all of these different parameters that are a little unclear, then I think that represents some significant challenges. Just to sort of pull forward some of the thoughts or some of the considerations the Supreme Court had about this question of fairness. They spent quite a lot of time in the judgment talking about the level of the commission. So in Mr. Johnson's case, 55% of the cost of credit was paid over to the dealer as a commission. That was deemed to be if you like, a bit of a red flag that arrangement itself might not be fit, and sort of echoes a previous case, Plevin, where which was a PPI case, where Mrs. Plevin had paid, I think it was 72%, by way of commission of her finance and PPI finance costs on the PPI. Now that judgment, I think, will take quite a lot of thinking about how that winds through, and whether we'll see the same sort of volume. Is a level of 55% the right threshold? Is 50% a better threshold? Might something even lower than that be appropriate? Different markets, different times, lots of things to begin to think about there. But I think the scheme could be far-reaching if it were to include all unfair commissions, whether they were DCAs or non-DCAs, and would need to really think about the different parameters that are in place. So level of commissions, certainly. They've also talked about the characteristics of the consumer. I'm not quite sure how they will get information across the line on a scheme-wide basis. So what sort of data would they need to collect to understand the characteristic of the consumer? Would they need to understand profession, for example? Where are they going to get that information from? Is it, I mean, it may have been captured as part of the credit approval. It may have been captured as part of the know your client type of things that the brokers do. But does it go back as far as 2007? Has that information been retained? And how will you incorporate and ingest that information into some sort of scheme that the firms will have to administer? So really quite large operational challenges once we know the shape and dimensions to the scheme, I think. But there's definitely some problems ahead in that short term in terms of redress. I mean, if you were to look at more medium term, long term issues, I think like Tom, this is about the brokers understanding what their responsibilities are around transparency, are around fairness. I bought a car at the weekend, actually, not just to understand I wanted a car, but to also understand the way in which that process operated. And I was a little bit surprised, I think, that the discussions about financing and commissions and how all of this would work were quite back-ended. And I think that's obviously because, you know, they want to capture you on the deal for the car, first of all, and then they figure out how you're going to pay for it later. And I think that some aspects of that will need to change. There's going to have to be more upfront transparency, perhaps more disclosure about we're going to get this commission. It's going to be £1,500, and £1,500 represents 30% of the total finance costs here. Those sorts of things I can see coming through.
And in a similar vein, what challenges do you think dealers and OEMs are likely to face going forward, at least in the short to medium term, Tom?
Yeah, I'm sure that I mean our view is the immediate impact to the to the market is there's going to be a loss of confidence from consumers. Dealers are going to have to go some way to make that up by being open book and probably going above and beyond the recommendations of what open book looks like and what fair is to the consumer. But there's a high probability that a number of consumers won't rely on dealers for their finance products. They'll look elsewhere. They'll use the third party market, and as a result of that, that means consumers will reduce their income. The income from that comes from those finance products will be reduced, and that will then have a knock on effect, as I mentioned before, to where they're looking to augment that from OEMs. So OEMs, as a result, will be looking to renegotiate the contracts they have with their dealers. They're very likely to want to understand a bit more about what products finance products dealers are offering, to ensure that there's no, or that the risk of reputational or further reputational damage is mitigated. And then at the back end, OEMs are likely going to have to readdress the relationship with their suppliers. If volumes ultimately are affected by this, there will be a negotiation on piece price of all of the parts, the minimum order volume that they will negotiate with suppliers. And so it's really about, I think, mitigating that relationship between the parties involved, the consumers with the dealers, the OEMs with the dealers, and likewise the OEMs with their suppliers too.
And sorry, just going back to James, how do you think firms should be looking to manage reputational risk and customer trust?
Trust has been somewhat of an issue in banking since the financial crisis. Banker bashing, as it was known, sort of in 2009, 10, and beyond, was really about this feeling that the financial sector had let down the UK consumers and maybe society as a whole. Since that time, a lot has been done, of course, to try and repair that damage. People will remember that there was a windfall tax placed on the banking sector. There have been conduct issues and conduct concerns right across the system, and a lot more tightening up about where regulation and compliance meets the customer. That said, this sort of issue puts you back there a little bit. There was something very interesting that Nikhil Rathi said earlier this week. He said that he wants this to be the last industry-wide redress scheme, the last failure, if you will, of regulation across the sector. And I think that's laudable. But I think it starts really at getting the regulation right, because I don't believe that the firms themselves really thought that they were not putting in place the right sort of regulations. I think the proof's really in the pudding, in terms of what came out here, in that the practice really didn't fit with what people said was going on. So there's going to have to be a little bit more close working, I think, between the lenders and the brokers in order to make sure that transparency exists in the future.
And given the way the judgment has now reduced the redress liability for lenders, could the government still intervene to further limit the financial exposure?
Yeah, I mean, the government can do what it likes to a degree. What it was talking about doing was primary legislation, really, to change the way in which retrospective redress might work. They were going to interfere mainly because they felt that this was systemic in terms of its risk, might cause firms to fail, might actually lead to a bad outcome for consumers, in that those firms that have failed wouldn't be able to honour their commitments to those customers if indeed redress was payable. I think that's highly unlikely now. It would have been an unusual step, so I don't see government getting involved in quite the same way. the government will be watching very closely where the FCA lands on this. I would be surprised if Treasury didn't get involved in the consultation. In fact, I suspect it's bound to get involved in that consultation. And so, really, I think it'll be concerned about the spillover effects and making sure that there's nothing untoward in the way to which that scheme's put together.
And if I could go to Tom for a second, do you think, Tom, this ruling has the potential to affect other sectors or jurisdictions?
Yes, certainly. I think what the Supreme Court came back with was stopping short of saying that the supplier, that the dealer in this case, had an ultimate duty of care to the customer in their commercial interests. They said that ultimately an arm's length relationship was commercially fair, but they did say that ultimately there was this question of the size, scale, and context of the deal needs to be taken into consideration, and there's that element of fairness. And when you consider other sectors like retail finance, insurance, and broking, in those cases there are certainly parallels where you could ultimately look at that and say, has fairness been at the forefront of the deal, of the products that are being sold? So I think that could certainly be something that other sectors will take a look at. And there's also the subjectivity element of it to consider in terms of understanding, for a different individual, are different parameters set around what constitutes fairness. So it's going to be a complex one to unpick for the FCA. It will no doubt be a complex redress scheme, and it's certainly going to be something that our clients, lenders, are going to have to consider when they consider what a redress scheme looks like. James, I don't know if there's anything that you would build on that.
Well, I had a question really for you, Tom, that sort of comes out of that. I was offered gap insurance on my new car on Saturday. I didn't take it out, but tell me about how that sort of market works, because it was only sort of vaguely offered to me as an extra rather than being particularly sold to me.
Sure. I mean, to set the scene here, if you take a step back, dealers typically would have made their profit and their revenue and their income on the sale of the car up until around 20, 30 years ago. The introduction of finance products and more advanced finance products, PCP, in the 90s with Ford, and then the opportunity to effectively drive commissions through things like insurance, like gap insurance, really switched the model, and actually making money on the metal became less relevant, and actually gave consumers more of an opportunity, or at least a perceived opportunity, to negotiate on the piece price, while the real money and income was being made on the finance and insurance products. I mean, gap insurance is one of many where effectively you're reducing consumers' exposure to a loss in the value of the car. If the car gets written off or if it gets stolen, the difference between what is paid out by your insurance company and the original value of the car is then covered. But ultimately, it's something that is being pushed forward and proposed by a third party. It's being sold through dealers as brokers of products. And so similarly, within the same sector, that there will no doubt be a need for dealers in the sector to take a closer look at that and say, are there other examples of this beyond pure finance products?
Finally, as we draw our discussion to a close, I also wanted to ask you both about the immediate future and priorities from the perspective of the affected boards and executive teams. How should they be thinking about managing both their immediate exposure to this issue and future proofing their business models against similar risks? Maybe, James, you could go first.
It's a tricky one. One thought that sort of reminds me of stuff from PPI. People might remember that all the banks wriggled a bit. They fought PPI, and actually, in some cases, they won. They won on a principles basis. And then I think it was Lloyd's Bank decided to fall on their sword on it and say, no, as far as we're concerned, there were instances where customers weren't treated fairly, where there was mis-selling of this product, and it would be correct now for us to acknowledge that and make a repayment and do that swiftly. Now, I think some of the way in which the executive teams approach this will determine how they're perceived going through this. So you can imagine making similar sort of calls to the regulator and haggling around different points. And Nikhil Rathi was talking about the banks not haggling now, please. We need to implement something quickly. I think there's a balance here. I think there's about negotiating something up front with the regulator that makes sense. And then when you proceed and when you've agreed the plan, you do it swiftly, you do it fairly, you do it with courtesy. There was a client of mine at one of the big banks who ended up for one reason or another running the redress scheme on PPI. He's actually quite a senior banker, but he thought that ought to be part of his remit in terms of customer experience. And he changed the way it operated. He changed the letters that were being sent out from being, effectively, here's your money, now disappear, to being a letter that said, I'm sorry we let you down. There was something that we didn't get right. It was a historic problem. We've done a lot of work to correct that. And I hope this draws a line under it. Please accept this, and maintaining really is a customer relationship. This is an opportunity to speak to your customer when you're making that address payment. So there are things that some banks will do very well here, and there are some that others will do badly. And I think that executive teams need to think about how they're perceived on the back end of all of this.
Yeah, and from a automotive perspective, if we start with the dealers, the larger dealers, multi-branch, large-scale national dealers, they will have boards and they will be putting in place the relevant compliance requirements. They'll be working with the FCA, and they'll be able to absorb this fairly effectively. But they'll want to certainly be perceived as taking steps in this direction and applying the rules of fairness. I think, going back to one of my earlier comments, a large proportion of dealers across the UK don't have boards. They are small family-run businesses. They're smaller shops. So, again, there'll be a need and a requirement, an administrative burden on them that they may find harder to challenge if they're required to do training or compliance and regulatory training. There's a challenge for them there. The OEMs, the automotive manufacturers boards, will certainly have a perspective on it. They will, as I mentioned, no doubt want to immediately get comfort in terms of what's going to happen with any increase in the cost and the impact of that on volumes. But they'll also be very much aware that the world, the consumers are looking at them as major players within the sector, and so brand management is going to be key. And I think as a result of this, they will work more closely with their dealers, making sure that the appropriate steps are taken and that they're working hand in hand with them. And I think that the ones that are on the front foot about this and most proactive about this, I think stand to benefit the most. They stand to demonstrate that building on what James was saying, that actually this is an opportunity to rebuild trust with customers. This is an opportunity to transform the sector and the consumer facing part of the sector into something that is better and more trustworthy.
James, Tom, thank you both for a great conversation. It's clear that while the Supreme Court didn't deliver the knockout blow that some might have been expecting, there is a complex, nuanced, and costly scenario for lenders, brokers, dealers, and regulators to work through. The FCA has confirmed it will consult on a redress scheme with the aim of finalizing it in time for compensation to begin next year, and the focus will be on recalibrating what we mean by transparency and how we treat customers fairly. Clearly, the firms that really lean into this by engaging early, communicating clearly, and doing all they can to operationalize the redress processes will emerge in a much stronger position. We will, of course, keep a close eye on developments over the coming weeks and months.